Julia Coronado, after years at the Fed, she's with BNP Paribas. We'll bring her in to get started here and talk about. We haven't talked much about the Fed. The target rate is. Don't butt yourself. What'd you do to your finger?
I cut it. I was catching a broken glass.
You were catching a broken glass.
It's a bad idea.
Can we see it? It's like my Dr. Phil moment. We're sensitive. Was it a Keynesian cut or is it neoclassical cut?
Oh, it was deep. That's all I can say.
Okay, it was a deep cut. It's like an Arthur Laffer cut, which he'd want to see on the deficit. Speaking of Arthur Laffer, do we need to adjust the deficit now? Or when we look at the trajectory, as Peter Orszag calls it, do we have time to address the deficit?
Well, I mean, the markets are going to tell us when we have time. I think the best situation right now is to address the structural deficit, to do things to curb spending growth, to address the entitlement programs. That would build a lot of credibility for the United States, giving us a little more room in the near term.
Okay, Bernanke, we haven't talked enough about this dreaded first chart. Here it is, Julia. You can see it down here on screen. Bernanke trapped, but liquid. Okay, we don't have a solvency crisis here. We've provided liquidity, and there's the Krugman liquidity trap down there in the lower right corner, down at 0%. Notice the length of that line. How long we've been accommodative. First of all, when are we going to see the Fed act and begin to raise rates?
I think it's still going to be a ways off. I mean, if we look at the amount of economic slack in the United States, it is still excessive. And there still are risks that worry the Fed. They're worried about the decline in home prices. They're worried about the fiscal crisis at state and local governments. They're worried about the turmoil in Europe and some of the unrest overseas. So there's a lot of risks on the horizon. Their central bankers, they're going to be cautious.
May I push back and say Germany booming, their index today, or was it yesterday, really doing well. HSBC talking about steam under the hood, smoke under the hood in Asia. Yes. Frederick Newman of HSBC. We've got a vibrant economy. What's your call for fourth quarter? Have you gone to 4%?
No, we're more at 3%, but a lot of it is coming from a drag from inventories. So if we look at final demand, that's above 4%, certainly.
Okay, fine. But when you look at all of this, there are good signs in the economy. Can the Fed ignore those?
The Fed is not going to ignore the good signs, but nor is it going to jump on the bandwagon and run away with 1 quarter of good growth. What we have not seen yet is any follow through to the labor market. So the labor market is creating enough jobs to sort of tread water, but we have not seen any acceleration in job creation yet. So the benefits of that good quarter have yet to spill into job growth. The Fed is going to want to see that before they take a deeper signal from
Another
this.
chart here. I love this. You mentioned the output gap. There it is. I get a tear when I see this chart, folks. The width of the U.S. output gap. And what I'm talking about there, folks, look at the zero line. Look how stochastic. So let me explain this. Stochastic means a bunch of things, but it sort of means like pointy. It's like a pointy moment in the 80s. Down we went. We came right back. A little bit of a lag there in the 90s, but look at that space. And critically, the OECD then takes their forecast out to 2012, 13, 14. That's quite an output gap. We've never seen this, have we?
We've never been where we are now. Certainly not in the data that we have. The last time we saw something like this was the Great Depression. Now we're not in a Great Depression, but we certainly are in a shock to our standard of living that's going to take years to adjust to. This is not a quick fix. This is not going to turn around in 2011.
Would you suggest that a good part of America is in some form of depression? As we look at structural unemployment, we look at the struggles of small business in the aggregate, and you are as guilty as every other economist. Let's think in the aggregate. I'm sorry, a third of the country, half the country, maybe more, doesn't enjoy that luxury, do they?
Well, that's absolutely right. And truthfully, I don't know anybody who hasn't been affected in one way or another. Right. Somebody has a sibling or a brother or themselves or a neighbor who's been unemployed for a long time. Pretty much everybody, I think, is making some kind of long-term adjustment. And I think that's why, we see a good quarter of growth. That's great news. Is it going to just follow through in a straight line upward? I don't think so. I think we've got bumps along the road.
Quickly, your 10-year yield call 1 year out.
1 year out, I think we'll be at 375. So by the end of the year, I think we're at 375. That's not far from where we are. I think that, the path of rates is higher, but it is truthfully a low inflationary environment, slower growth than we used to think was the norm, and that means lower rates.
Julia Coronado with us from BNP Paribas, and now joining us from RBC Capital Markets, Michael Cloherty. Michael, good noon to you.
All right. Hi, how you doing?
Well, I'm very, very good. I want to bring in a chart from Julia Coronado here, which speaks to both of you. Let's bring this up right now. Core services, ex-shelter. Excuse me, this is the number. Sorry, that's my fault. Rex, bring up the number. Here it is. Julia Coronado, in your research note, 3-month annualized service sector inflation, take out rent, housing, and all that. It's deflation. Michael Cloherty, let me start with you. Do we still have a deflation fear?
I think it's faded. We're starting to see actually some signs of inflation over in Europe and some of the other developed countries. Again, we don't think that the inflationary risks are here in the U.S., but that plus the stronger growth background we've had has really diminished the deflationary fears. You
wrote this up in your research report. Okay, less deflation. I'll buy that as a consensus view. Is Ben Bernanke still on the disinflation watch?
I think it's too soon to sing the victory song for Bernanke. I mean, if you look at where consumers are cutting back, it is in services. Service spending has been extremely weak. It shows no sign of accelerating, and consequently, we're not seeing any pricing power for services. So we still have, as you noted, a huge output gap. The labor market isn't feeling the love from the growth, and until that happens, and I think it's a long ways off, wages are slowing, and that puts downward pressure on prices.
Let's do some explain this. This is important for those of you that didn't take the Julia Coronado lecture. Inflation, prices up. We all know that. We're hardwired for it. Disinflation is just less inflation and a lowering trend of inflation. Deflation is actual prices going down. Michael Cloherty, the add-on to prices going down with deflation is wages going down as well. It's a pretty murky wage economy as well, isn't it?
Yes, we do continue to see softness there. We've seen a little bit of an uptick in hours, so the total take-home pay isn't quite as weak as the hourly pay has been.
I mean, you look at this, Julia, and trying to link together the fixed-in call. A lot of people have predicted higher interest rates for a long time. Michael Cloherty himself pushing against that. What have they been most wrong on? Is it the output gap, or is it the Chinese buying our paper, as was vogue 5 years ago?
Well, there's that story. So there's always the thought that the bond vigilantes are going to show up and finally make the U.S. pay for the budget deficits. That hasn't been the case because we do have many emerging countries still supporting their currencies and channeling money into the dollar market. That keeps rates low. The other thing that we have been wrong consistently about is the labor market. It has consistently been weaker than expectations. We keep looking for the job acceleration. It doesn't come. And so as long as that's the case, you've got a queue of workers bidding down wages, and that has yet to show signs of stabilization. That's pretty important.
And now we cut to the chase, folks. The most important part of the week. Michael Cloherty here. Michael, does it drive you to drink to hear economists, blowhards like Julia Coronado talk about the bond vigilantes? What's a bond vigilante?
Well, I think that in the last year we've had another thing besides what Julia was mentioned that's kept rates down. That's that while there's been a tremendous amount of Treasury issuance, more Treasuries than you can shake a stick at, private sector debt has been shrinking very rapidly. There's been a big deleveraging going on in the economy. And because private debt is so much larger than Treasury debt outstanding, the total amount of debt in the economy has actually been going down, not up. As we look forward the next couple of years, we think we're going to start to see some turn in private sector debt outstanding. And that's when we'll really get a sense of, are the bond vigilantes back in action?
What's a vigilante? But help me here. Both of you are like real pros. Talk about jargon. That's like a jargon alert for 30 minutes. Julia, with all respect, economists trot out this phrase, there's a bid, there's an ask. Is it like what's the word? Cabal? Is it cabal? Is it like an evil group of vigilantes? It's like the gnomes of Switzerland. Lou Rukeyser used to go mental about the gnomes of Switzerland.
I think Paul Krugman likened it to the boogeyman, that the bond vigilantes are the boogeyman that never shows up. The idea behind the bond vigilantes is that the U.S. is running huge structural deficits. We shouldn't be seeing rates as low as we've been seeing in the last 10 years. Chairman Greenspan called it the bond conundrum, another term for you, if you will.
Right.
And it all means that we should, technically speaking, have higher rates given our budget deficit situation, and we just don't because people need dollar assets.
Michael, have you ever hired a vigilante? I mean, come on, you get some kid out of Wharton or wherever, and he goes, I'm a vigilante. I mean, seriously, we try to, I go nuts about this. My glasses are steaming up here. I'm getting so upset about this. Michael Cloherty, let's bring up this chart. It's a serious chart. Debt, past the 90% hurdle. Reinhardt and Rogoff talking about a 90% hurdle. Ken Rogoff will join me in Davos. And Michael Cloherty, you see this buildup in the debt limit, 14 trillion. Do you believe in the 90% hurdle when we get past that? We get into fiscal instability?
Again, I don't think there's any magic number out there. But, we do have a situation where the Treasury is going to be facing more and more maturing debt that it has to roll over in the next few years. By the middle of the decade, we're going to have about 3 times as much coupon debt maturing as we had last year. So the same size Treasury auctions aren't going to raise nearly as much money. So we're going to have to see, even if we are able to, Congress is able to lower the deficit, you've got auction sizes going up, not down. If we don't get any improvement on the deficit, auction sizes have to go up dramatically, and then we need a whole new raft of buyers to come into dollar assets to keep rates here.
Michael, thank you. Julia, just the last word with you, the deficit we come up here. What happens when we get over 14 trillion? I mean, we're there now.
Yeah.
Just keeps building up every year.
It does. Yes. I mean, we have unsustainably large budget deficits, and we had those going into the crisis, and then, of course, we built up rapidly new amounts of debt that we now have to pay down. So when we think of that in terms of the economy's potential growth rate, it's definitely going to be a drag for many, many years.
Right. Thank you so much for coming by. Julia Coronado, BNP Paribas. Let's bring up a research note, Michael, that you were kind enough to send over. Bring that up if you can, Rex. There we are. Smaller deficit, bigger auctions. This is an important theory. We're going to talk our way through it. Maturing Treasury coupons will soar in the next few years, meaning that current auction sizes raise less cash. More pressure on Congress. Michael, let's go deeper on this. This is a big deal. It's some nuance here. Run us through this thinking.
Well, basically, right now, if you have a $35 billion 2-year note auction, that'll raise a lot of money. 2 years from now, that $35 billion 2-year will start maturing. So if you still have a $35 billion 2-year note, that doesn't raise anything at that stage. So the fact that the, beginning with the surge in budget deficits back in 2008, we started to have to see a sharp upward spike in auction sizes, all those maturities are starting to come due. We're going to have to see, even though we do think the deficit is going to improve in the next couple of years, we won't have stimulus next year to the same degree, and we do think better growth will push things down. It still means that maturity means there's going to be upward pressure on auction sizes rather than downward pressure.
Well, and we bring up a chart, folks, you've seen many times on the show, the long-term bond. Let's call it the Paul Volcker chart from 1980 back. It's an elegant chart. The output gap dampens yields. Okay, Michael Cloherty, Julia Coronado says there's a big output gap, and maybe that's kept yields down. Are we going to see a more gradual trajectory up in yields, or is there a risk of a jump condition where we really start to move up to Byron Ween's 5% 10-year yield?
We do think we're going to see a grind higher. The jump higher, I think that the output gap really is the constraint on that, is that a jump higher, you'd need to see some inflationary fears on top of the deficit fears, and that output gap is really too big to generate a lot of inflationary fear right now.
That's important.
So a grind higher.
Yeah, I like the word grind. I use that too much, too. This is important, folks. These words to economists and strategists mean a lot. It's not only the direction of the move, but it's how you get there. Michael Cloherty, did you buy the idea that higher yields can signal a good or a bad economy?
Yes. I mean, in the majority of the time, higher yields means that economic activity is very high. There's a lot of people borrowing, and so that normally high yields is a good sign. The problem is, you can have high yields due to inflationary concerns, due to concerns about your currency, and concerns about budget deficits. Those things actually slow the economy down. That's a bad sign. The move we've had thus far in yields, I think, has primarily been a good rise in yields. We've had a little bit brighter growth prospects. The whole fear of a double dip has diminished. The worry is that the next leg of the move will be the less helpful bear market, where people are concerned about budget deficits.
I want to bring in the Jeff Immelt op-ed. We're going to run this, folks, as we go out here. Jeffrey Immelt, General Electric Chairman and Chief Executive Officer. And let's bring it up here, if we could, a blueprint for keeping America competitive. His new duties with the president. General Electric sells more than 96% of its products to the private sector, where America's future must be built. Michael Cloherty, when you see these kind of appointments, it's got to make you feel good about the political economics of Washington as we go into the next couple of years.
That certainly does, but again, we'll see. It's now that we have a divided government there, we'll see how those changes translate into action, whether we're able to get legislation passed or not.
Okay, let's leave it there. Michael Cloherty of RBC Capital Markets coming.